Welcome back to Trading with Artisan Will, and this is part one of my top-down guide to options trading. Now, this guide is going to be really great for the beginners who are just starting to learn options trading, and you just want to learn the very basics of technical analysis as well. Or if you're just trying to get a refresher, because it's always good to go back to the basics and kind of rebuild your foundation. For a little background, I've been trading for over 7 years now, and I've been profitable for around 3.5 years. And I really wanted to make this guide as a way to rehash the things I've learned, but also show you the kind of mistakes that I've made along my trading journey. So hopefully you make less of them or even don't make them at all. So I know that you've probably, if you're interested in trading, you've heard about crazy technical indicators like the GAN or Elliott waves or the moon cycles, or even something that a lot of people follow, like fair value gaps and ICT. Now, what I want to tell you is if you're intimidated by these crazy technical indicators, that you don't have to use them. Now, full credit to the people who are actually able to use these fundamentally difficult concepts and they're able to stay profitable. All credit to them. But the point being is that you want to try to find a style of trading that fits not only your personality, but also the type of person that you are. And so if you're very, very analytical, then maybe something like ICT's strategy of using fair value gaps is something that might be good for you. But as a whole, my strategy focuses more on swing trading and something that you don't really necessarily have to go too deep into the technical analysis part. At the end of the day, I've found that it's a lot easier when you keep it simple. The thing is that when I start adding a bunch of indicators to my charts, what ends up happening is I start overthinking and my mind gets overloaded with how much information is actually on the screen. And given the fact that the stock market is already super stimulating and moves so fast, you need to be thinking clearly to be able to act quickly on your feet when there's fast news, or if you have to make a decision on whether or not you should be taking profit or taking your stop loss and actually closing out that trade. So having it very simple is a way to make it a lot easier for yourself. And this guide is going to walk you through how I am doing that with my strategy. The biggest two key components is going to be consistency and risk management. There's a saying where there's multiple ways to skin this cat of what we call the stock market. The biggest part that really, really matters though is actually staying consistent to your trading strategy and not constantly flip flopping, as well as managing your risk. This means you should know when to go risk on and put your foot on the gas pedal when the markets are favorable for your strategy, but you should also know when it's better to just stay sidelined or scale down because the markets are either choppy or just not favorable for the type of trading that you are trying to implement. So I've already touched briefly on my strategy and how it's primarily focused on swing trading, but we're going to go a little bit more in depth on why that's the way I want to trade, but also we're going to go super to the basics as we're going to learn how to read candlesticks, we're going to learn how to identify support and resistance on charts, but also learn how to utilize that together and combine it with trend lines to identify potential trade opportunities that are in the market. So the reason why swing trading is so powerful is because a lot of the moves that happen in the market are outside of regular trading hours. The reason why is because a lot of news or data comes out when the market's actually closed. This is going to be your economic data like non-farm payrolls or unemployment rate, but also it's going to be your earning reports or any price analyst upgrades that certain banks or funds will do. And so when you actually start to try to day trade it, the stock's already up 4 or 5%. Your risk to reward is really, really unfavorable at that point for it to continue upwards during that actual trading hour. Whereas if you entered maybe a week before or even the night before, you've already captured that 4% gain. So you're not really risking the same amount as if you were just entering fresh off the start at market open. And you have to remember, you want to think in probabilities in this game of the stock market. And what that means is you want to set yourself up to be in the most favorable position and the most highly probable trades where you will actually be able to come out profitable. And swing trading, I found, is probably one of the most powerful ways to do that. It's just not worth doing and risking that day trade, especially when you're fighting against algos or people who have access to news or information way faster than you. Now, seeing as this is part one, let's go super into the basics with just literally knowing what a candlestick is. And the reason why candlesticks are so important is because line charts suck. So if you go on your stocks app chart on your iPhone or even just Google and you Google a stock, for example, Apple stock, right? It shows you this line chart. And so this tells you the closing price that was traded for that certain time frame throughout the entire chart that you set it as. The reason why this isn't good is because it doesn't tell you all the information that's available. It doesn't tell you the prices that were traded between the entire time frame where eventually it closed at the stock price that is what's showing on the line chart itself. And here is a really good kind of explanation of how that works. Regardless of whether or not it's a bullish or bearish candlestick, you're going to have wicks, which are going to be these upper wicks, these lower wicks. These show you the price of the stock that has been traded throughout this entire candlestick. So if it's on the daily time frame, it shows you all the prices that that stock was actually traded at. And this access to more information of how the price action was is really powerful because it tells you if the stock opened at a super low price, but then it actually ended up getting bought up the entire day, that potentially tells you that there's a lot of buying pressure and it's something that you should keep an eye on for maybe a continuation in the next couple days in the trading hours. And to get a little more deep into the technical analysis part, there are certain candlestick patterns that have been observed in the stock market to where it can potentially indicate a directional move coming in the near future. Now, I want to preface this with saying that you don't want to use this as the holy Bible or just like the sole reason why you enter a trade. You want to use other indicators or things that you see in the market that's giving you confluence to believe that this move is actually going to be happening. Remember, high probabilities, right? If you see a bullish pattern happen on a certain time frame on a chart, but you also see other things that give you confluence, that should increase your probability of this trade actually happening and going in the direction that you think is going to happen. What I really recommend to a lot of my mentees is just literally print something like this out and put it right next to your setup. Whether it's like tape it on the wall or even just keep it on your desk so you can just briefly kind of reference it every time while you're watching the stock market in real time. Let's go over a few of these candlestick patterns that I've seen to be very, very powerful in my trading experience. The first one's going to be a bullish hammer. And the reason why this is a really powerful candlestick pattern that I've seen work out really, really favorably in the market is because it tells you a lot of the price action that happened during that time frame. This is on the daily chart, and what it tells you is that for the entire day, it sold off to this point, and despite all this, at the end of the day, it actually ended up closing above and here within the candle of the previous day. This tells you that there was a lot of sellers present, but buyers were able to buy it all the way back up and springboard it back to the price in the range that it's been trading in for the past couple days. Buyers and sellers agree that this is a fair price to trade for that stock, and there could be a potential continuation to the upside. And that's exactly what you see happen on the next day and further on. The next pattern is going to be these inside bar slash inside days. Now, it always happens where you see a large candlestick of volume where there's a huge increase in price, but then the very next couple days is going to be candles that are traded where price is within that large candle. This is what I like to see as digestion and acceptance of the stock price trading at these new high levels. You have to remember that price action tells a story of a battle between buyers and sellers. Now, when you see these inside bars and consolidation, this tells you that buyers and sellers are slowly accepting that this stock, for this is Costco here, is they accept that this is okay to trade at these new prices. And when this happens in a directional trend, what you'll often see is that there will be a continuation of the trend that's going on. And for in this situation, it's going to be to the upside. This can be seen as inside days are taking a breather where buyers are just resting before they continue buying and it up springboard the price back further more. The next chart here is going to be meta on the daily time frame, and this is a good example of showing you that these candlestick patterns can't be used as an end all be all. So you can see here that this is actually a bearish engulfing pattern, meaning that price was actually sold off really heavily and broke past the previous day's candle low and actually closed at the lows here. Now, when you first look at this and just this part, this could potentially tell you that there's more downside continuation possible for Meta here. But the problem is that you actually see as the next couple days, they're inside days, but then we print a bullish hammer and we actually reverse off that spot to the upside. So this is just a really great example of how you can't just use one thing slash indicator to tell you how to trade a certain way. You have to use multiple indicators or observations that you see in the stock market to give you support for your thesis of how you want to trade it. Now, what are these other indicators slash observations? We're going to dive deeper into that as we continue on this guide. One of the most basic parts of technical analysis is knowing what support and resistance is and where that is on the chart. Essentially, again, we talk about this buyers versus sellers story. Support is the price range and area where buyers are likely to have control. So if price is coming down and it's going to a certain price point, you're looking for a spot where buyers are likely to take control here for price to potentially bounce and go back up. On the other hand, resistance is the price area where sellers are likely in control. So this is usually where you see price start to move up and then hit a certain point and gets rejected and pulls back as there are more sellers than buyers in that range. Let's take a look at how we can identify this support and resistance areas on actual charts. So this is going to be Costco again, the daily time frame. And essentially, when you're looking for support or resistance, you want to see price areas where price has hit that spot multiple times in a large period of time. So if I'm looking at resistance here on the left side of this chart, I see it here at around the 908 area. It gets rejected here twice on the daily time frame. And then we actually try breaking out from that 908 area, but we quickly get rejected and pull back under that level. We reject it again here, and then finally, we actually break it here and springboard price up past that point. What this tells you is that as sellers continue to get whittled down as price hits that spot, it tells you more buyers are getting those sell orders filled. And so eventually, when it actually explodes past, it's because there isn't that much resistance anymore. And when you're looking for a continuation for the trend that it's going towards for the stock price, you want to see that previous resistance become new support. And that's exactly what happens here a few days later after this price explosion past 908. It actually pulls back to that 908 area and uses it as a springboard to propel price back up. This shows you that these new market participants think that Costco is worth at least 908 or even more. And so all these buyers are coming in to bring price right back up. And then to further support this idea that this 908 range is a really, really good spot for support, is that it does it again 2 more times, where it literally does not want to close under this 908 area. And this is kind of utilizing the candlesticks and this new concept of support and resistance, right? Because you want to wait for this candlestick to close to tell you what happened. This candlestick tells you that sellers tried bringing price down and close under 908, but at the end of the day, they failed to do that. And then they actually failed to do that again here. And then obviously it uses this as support to springboard and actually skyrocket price past $1,000 per share. So this is the chart moved up a little bit where we actually saw 908 become the new support where it was old resistance. Now, if you look up here in the purple circles, this 1006 area is new resistance because we rejected it 3 times here. And that's where the candlesticks actually wicked. So on a line chart, this wouldn't likely tell you where actually price went. Whereas on the candlesticks, it shows you that this 1006 area was heavy, heavy selling pressure and heavy resistance because we wicked it and the candles were far from closing near that area. And so if you are looking to trade this opportunity, you could potentially look to see, okay, this is a good resistance point. I would like to be bearish on Costco and play the downside. Where would your target be? The target's probably near that 908 area because that's where it bounced in the past. And on the contrary, if you're looking to be bullish on Costco stock, you would look to potentially enter calls or longs at this 908 area, targeting the top of this resistance point on the right. And what we see happen is it did bounce at 908, and then you were actually able to close under 1006, but the very next day it actually blew past resistance and had a continuation. So if I was looking at this chart, I would be looking for potential support at this 1006 area as a maybe a small entry for longs to see if this new support area is actually going to hold or if it's just going to be resistance again when price pulls back more. Here's an example of where the previous resistance failed to hold up as new support. So this is Tesla on the daily time frame here. You can see that this 358 price range is heavy resistance because we wicked it here, we failed to close above, and as soon as we opened above that price point, price actually got rejected super heavily. And we tried consolidating 3 days here under 358 before we actually continued upwards in that price momentum trend up. And then as we pulled back a bit here, we see that it failed to really hold 358. And as it blew past it here and then it bounced back to 358, we see that it took about 5 days for price to really struggle. Like this is where you see that battle, right? Of the buyers trying to use 358 as support. And what actually ended up happening is sellers ended up joining the party and dominated the buyers to where it propelled price back down to even further lower prices. My best piece of advice is to just look at a chart and try to kind of identify these zones where price has reacted really well, whether it's support or if price reacted really poorly, being that it's resistance. And just see if you can identify those spots and see if price is able to respect that. Doing a lot of this back testing is going to give you confidence for identifying where these potential support and resistance zones are. You want to train your mind to be looking to see where a lot of buyers can potentially come in or where sellers can come in and swoop it and actually determine how price reacts. The next fundamental piece of technical analysis is going to be trend lines. These represent sentiment change in the stock that you're looking at. And simply put, how it works is you connect price points to help you identify the trend of how price is going over a longer period of time. Let's look at an example here. So this is Meta on the daily time frame here. As you can see on this green line, it's clear that Meta stock is trading at a downward trend. We tried breaking it here, but we got a fat rejection and we ended up pulling back pretty aggressively. And so when I'm looking at this downward trend line, I'm looking here to see that there might be a trend line break. And what you see happen here is that sentiment changes really, really aggressively and price moves so fast here. It opens at around 576 and closes at 550, 588. And then what happens for the next couple of days is it continues to run forward. This shows you that when there is a trendline break, there's a big change in how buyers and sellers are viewing this stock. When buyers completely take control, it shows you that some of these sellers might actually cancel their orders and actually join the party. Now, let's take a look at Costco again. This blue line represents that resistance points that we were talking about and how it actually flipped to become support at 908. Now, when we utilize that and the candlesticks and the trend lines, you can see some type of trade plan start to formulate. This trend line drawn by the green line shows you that there's a clear downward trend. We tried hitting and breaking it 4 or 5 times here. And then eventually, this is a bullish hammer candlestick. And then eventually the next day is that explosive move past this trend line break, but also that previous resistance of 908. It tells you that when there's this trend line break, sentiment changes and an aggressive move is likely to happen in the near future. Essentially, with trend lines, you want to try to piece it together where price reacts to that trend line multiple times. The more times that the trend line is actually hit by price shows you that it's a more respected level. Now, I know that this part of technical analysis it can be very subjective, and that's why you have to use it once again with a grain of salt. And that's why I talk about how we utilize not only the candlestick patterns, but we also looked at support and resistance and combined it with the trend line to give us an idea and a thesis of where we think price might go in the near future. And a big emphasis point is that I like to think of every trade as a potential business action. If you are running any other type of business out there, you always consider the risks as well as the potential payoff, right? And you list your reasons why, the pros and cons. You say, there's these reasons why I think this investment's good, and here are the potential risks with that comes in. And with every single trade you take, I want you to try to think of it like that. The support and resistance zones, the trend line break, as well as the candlesticks, these are your three core reasons for why you should potentially take this trade. And then your risk is something we're going to talk about later on in part two. So just to recap, we learned why candlesticks are so much more helpful than line charts, and because they give so much more information on the levels and prices that were traded during certain time frames, but also that we can utilize that information to identify support and resistance on charts. And you can use this for any single chart that's out there in the world, and you can try to see how price reacts around these zones. But combined with all of this, you can actually use trend lines to formulate a potential, like the start of a trade plan of how you want to trade a certain stock. Because now you can use these trend lines combined with how the candlesticks look, as well as where support and resistance is, to create this idea of where you think price is going to go. These tools will help you set yourself up to be in the highest probable scenarios where your trade might actually go through and where you think price is actually going to go. And in part two, we're going to talk about how we can utilize these things to create a actual trade plan and act from there.